Good morning, everybody. It's Dan Kautz.
Good morning, Jeff Buckley.
And here we are in June already for our webinar for June. Can you believe it? June.
We've managed to cram a lot of activity in the first 5.5 months of this year so far. So.
No doubt, no doubt. It's moving along fast, but we seem to be doing a little better in the markets and whatnot. We'll get to that in a little bit because I got to do my slide right here, right now. This is a quick check-in call. As you know, we can't take any calls or texts while we're recording this and while we're speaking here right now. And our contact information is dkautz@kautzbuckley.com and jbuckley@kautzbuckley.com. Our phone number is 716-276-8480, and our ever popular text line 716-272-1129. So, Jeff, as you always say, you want to look in the rearview mirror first and take a look back on how things were going in the last month, last 12 months, last 52 weeks. So why don't you jump right in here?
Well, sure. Again, our start with the look in the rearview mirror, as Dan said. So May was actually a pretty darn good month. If you compare where we came from in April. Going back, we basically just clawed back a lot of the gains that we had seen in the markets through January, February. The tariff announcements came out, and we're still in the middle of that. I mean, the tariffs are on a daily basis. There's some news that comes out, and the markets are still roiled by that, I think. But I think there's also a kind of a feeling that maybe they're not going to end up at the rates that were initially announced by President Trump, and that may or may not, we're still waiting to see on that, but may or may not have quite the effect on businesses that we initially thought they could have. So this is just a quick look, and again, we're just kind of glancing at the indices here that we follow. Again, 100% stocks in these indices. So we're not really looking at any of the bond or the more conservative investments, but just from a stock perspective, you can see that May was really a pretty significant gain, and a lot of the high-tech stocks really kind of led the way. They had taken quite the punishment when the tariffs were announced and fell, but then they were able to recover in May. Still healthcare, unusually so. It's had a tough year, basically. NASDAQ, biotechnology, these are the healthcare companies that are very tech-oriented, really the worst out of the month of May there. But the kind of the interesting figures here, really where we were is, you can see during the month of May, we're still down from our 52-week highs. Now this is, you got to kind of think of a timeline when you look at these perspectives, because this is going back a full year. And remember, the markets had kind of ramped up all the way through the inauguration of President Trump, and then the first month or two after that, then the tariff announcements came out, we dropped, we recovered well in May, but when you go back a full year, we're still trailing, okay, at least through the end of May. However, we also set in April a 52-week low. So again, going back a full year, we had hit some bottoms there, and look at the bounce that we had. This is through kind of the end of April and then the month of May.
All right, so this is the month of May, and that's since April.
Well, this is really, since when we hit the bottom, and that was right after the tariff announcements, and we really plummeted, and we bounced quite a bit, but we're still, at least through the end of May, we still weren't quite where we were.
52-week highs.
Yes, yes. Right. So, an interesting month, a lot of volatility. But again, as Dan and I have been harping with a lot of our clients right now, I mean, your time in the market, not timing the market, because things have been moving exceptionally quickly over the last couple months. But you can see if you panicked a little bit and ran for the exits in April, you missed the recovery. Okay, so it's staying in the market, staying invested. We work with people every day. We set those long-term goals, and we say, listen, the little blips in the market here and there, even some significant blips in the market, when you average them out over time, you're gonna be okay. All right.
There's a saying I heard over the week too. Is we went to a great meeting called Investment Masteries, where we had a lot of our money managers talking with us, and we had a lot of conversation around the first part of the year. But it was a very good point, I thought, made about investors' philosophies or mindset when you get into turbulent markets. It's all of a sudden that long-term view you had on your money, when things get choppy, your long-term view gets
Yes.
shortened. And you can't let that happen. The purpose of the money is still a long term. It's just suddenly it's front of mind, the news is hitting you, and all of a sudden it's holy cow, what are we doing today? And that's where some emotions take over. So we had a lot of conversation around that. It was interesting, but I'd like to say when we talk to our peers and all, our clients are doing just fine.
Yes, we are.
So here we are.
Yeah, and this is the sectors. This, again, just a little bit more of a focus. Again, look in the rearview mirror, what happened in May. But you can see there definitely was a difference. Healthcare, again, kind of bringing up the bottom here, really. But technology led the way kind of in that bounce after the tariff announcements and the market drop there. And then again, just kind of the same perspective, it just exactly how volatile really the last, say, 60 days have been. So, yeah, the next, now, this is again this is kind of the lookout, the windshield, the immediately what's happening right now. Dan and I like this because a lot of what we talk about is really focused on stocks in those first couple slides. Not much on the bond markets, but yet all of our clients have a well-diversified portfolio. Some are going to have more exposure to the stock market, some are going to have less, depending on your risk tolerance. But this is more of a snapshot of how those portfolios, really how your portfolios are doing, and you can kind of see where you kind of fit in here. The more aggressive investors are going to be about 80% equities, 20% fixed income, whereas our more conservative investors are going to be closer to the bottom, which all the way down to about a 20% equity exposure and 80% fixed income. So what's very interesting, I thought, when I was putting this chart together is, and this is again through June 9th, so pretty recently here, the total return year to date, very little difference. In fact, the bond portfolios have actually outperformed a more stock-heavy portfolio. And again, a lot of that has to do with the bond yields that we've been able to get for our clients here. Good, decent yields there. When you expand out to a total 12-month return, so this is essentially going back from June 9th of 24 all the way up through June 9th of 25, you can see again, what we would expect, a more conservative portfolio, not as aggressive, so the risk return level isn't there, but it's still a decent return, 8.10% versus a little heavier stock exposure. You're getting a little, with taking that more risk, you're getting a little better exposure. But when you go out over 3 years, you start to see where that really has made a difference, because there's been so much volatility in the stock market, really. The bonds have been kind of steadily earning their yields, but there's been some outperformance on the stock side. Now, when you go 5 years, now we're still taking into account 2022, which was the bad year for both stocks and bonds. So eventually this is going to kind of work itself out, and it'll be interesting to kind of see where those numbers are. But even a more conservative investor, especially over the last year, has been able to generate a very decent rate of return on their portfolios.
So I got to use the magic pen there.
Good.
I was all excited. So we'll put it back since I had an opportunity to use it once. Moving on to the speedometers, we're still kind of caught in neutral. But, I really thought just the other day, this week, the announcement from the Trump administration was that we had to deal with China. And I really thought the market would rip up, but it didn't. And we talked about that. We're okay with slow and steady.
Yeah.
We're okay with that, and maybe move, because volatility up. It's still volatility.
That's right. And I think part of the concern is we are getting hints at progress from our administration here, the U.S. President's office, but it's through the cabinet members and everything, but we're not necessarily getting a lot of facts, okay? So it's positive in one regard, and the markets are responding to that. There's talks going on, there's negotiations, there seem to be progress, certainly. However, we're not quite sure exactly what that progress is yet, and again, the markets are looking forward. They want to see how these are all going to shake out. So, we always talk about the colors here. That's the first thing you see when you look at this chart, and the yellow is dominating again. We've got a lot of caution out there. We've got a couple green ticks here, but not many, so we're still cautiously optimistic, kind of see where things go. I did find it interesting, though, that we are right around, when we're recording this here, just a couple days after June 9th, essentially, we're really within about 2 percentage points of all-time highs in the stock market. The S&P 500, again, focused only on stocks, but the 500 largest companies, and the NASDAQ as well, which is the tech-heavier index. So we're very close to these all-time highs. However, it's also interesting too that these tariff battles are going on with other parts of the world, and Europe is certainly one of them. And Europe has been outperforming the U.S. market so far year to date too. So once again, what Dan and I always preach: diversification. We have exposure to those international markets in our portfolios. Our money managers are reallocating some assets to take advantage of those more rapidly advancing markets in other parts of the world. So you'll start to see when you look at your portfolio allocations, that international exposure is definitely increasing a little too. So that's kind of the look out the windshield where we're headed, really. So. I just thought I picked up a couple slides here that I thought were kind of interesting. Just give us an idea, where things are. I guess to try to sum it up, what seems to be the consensus out there, and again, as Dan mentioned, we were just at an Asset Mark event and had a number of money managers giving presentations on what their current outlooks were for the market. We're starting to shift to that second half of the year outlook that a lot of the big money managers are producing. And what they're essentially saying is if the U.S. consumer keeps up their spending activities, inflation stays where it is. We got some very good reports this week. Inflation still seems very tame, very under control. Now, the financial markets don't always like that, because that may mean that the Federal Reserve can continue to push off a rate cut, a little sugar there to keep the markets excited. But really, a lot of this is, and really, when you think about it, it's really the global economy depends on the U.S. consumer. And right now, we seem to be doing pretty well. And it's interesting, there's a little bit of a dichotomy going on out there. And you can see, I just kind of took this quote. This is a report from Cerity Partners. Despite negative consumer sentiment, so what that means is they're taking polls, and all of us are saying, yeah, we're a little nervous. We're keeping the wallet in our pocket and everything. However, U.S. consumption remains resilient due to strong spending, especially by those high-income households, and also on essential expenditures like housing, healthcare, and those are supported. Why is that continuing? Well, it's supported because our unemployment rate is extremely low, and our labor market has remained very strong. You're starting to hear a little bit of an indication here and there from some employers that are really coming out with some layoff announcements, but they seem to be spread over the next 3 to 5 years. They seem to be relatively small percentages of those companies' overall workforces. So when that's happening, people have jobs. They feel more secure. They're willing to go out and spend money. And this chart just kind of shows that we're really still the consumption is out there. So that's
what's
positive.
The red line mean here, Jeff?
Well, that's the 2-year average. So you can see there's a lot of ticks above that, but when you average all those out, we've certainly had some negative periods in there, and one of them was right after the first of this year. But right now we're still, we're a little below the 2-year average with the reading through April. So this is a little dated, but not much. We'll get some more up-to-date information that we can share with everybody next month. But we're still doing pretty well, really. So the next slide, this is, and again, a lot of focus on the job market, on unemployment. So this is just kind of, I thought this was interesting because we hear a lot about it, but I like to try to let you visualize where it stands and from a historical perspective. So this chart goes all the way back to May of 23. So we're really looking about the last 2 years. And for a while there, we were around 3.5%, which is great.
By the way, is very low.
It is extremely low.
Back.
Historically, even where we are now,
it's called frictional employment. We're right at 4%.
Yeah, so
Right,
we're in
right.
good shape, but you can see nothing is spiking. There's not been any huge shocks to the labor market, even after a lot of the DOGE cuts to the federal workforce. Now, again, a lot of those are tied up in court, where it's a little unclear as to where those are all going to shake out.
And
but
when?
and when exactly
Because
too.
people that did take the buyout are good till September.
Yes, yeah.
So we might see a little difference, but to go on.
Well, yeah, no, I was just saying that. That's kind of where we are, and again, that seems to be what's the support for that consistent spending from the U.S. consumer, and that's driving the world economy, really.
And for now, it's strong, robust. It's
Yes.
there. We've been hearing so much on the news about unemployment, as you just alluded to,
Yeah.
and it's nice to be able to say, just block the news out, give me the number, give me the signal,
Right.
and we're pretty good.
Yeah.
So let's see what happens.
Yeah. So things to watch for, though. Obviously, if and we're doing the same. We're working with our money managers. They're watching every tick in the market on a daily basis. What Dan and I follow, we're looking at the unemployment rate, because if they start to creep up in that regard, if we start to see announcements of additional layoffs, that may undermine the strength of the U.S. consumer, and that could present some problems. Tariffs are still an issue. We want to have things to consume. As Americans, we want the store shelves filled, and we'd also like it at great prices. That's why companies like Walmart and Costco do so well. They get out there and hammer those producers and keep those prices low. So there are possibilities of some chinks in the armor here. But right now, at least, things seem to be holding up pretty well. We're slowing, but we're certainly not coming to a stop.
I was just going to make that point.
Yeah.
But very good. Here we are now. What's next? What do we think?
Yeah. Well, these are, I don't like to throw up a lot of words here. I apologize for that. But these were just two quotes. I got this out of a Morgan Stanley report, and I read a bunch of things, but I thought these kind of hit well. After growing 2.8% in 2024, and what they're referring to is that's 2.5% for the fourth quarter year over year. So that'd be 2023 versus 2024 there. U.S. economic growth is likely to slow to 1.5% this year and 1% in 2026. So again, we're slowing down, but we're not slamming on the brakes here. So I thought that was an interesting perspective, and I'm sure also, depending on how things play out over the next 3 to 6 months, these numbers will be revised too. They're revised almost on a bi-weekly basis.
Count on it.
Yeah, but that's it. But then inflation is likely to accelerate and reach a 2025 peak between 3 and 3.5% in the third quarter. Now, again, very low interest rates or inflation rates that we've seen in the news lately. However, these were all really pre-tariff.
Right.
These were they knew the tariffs were coming. They had loaded up on goods. They over-ordered. Yeah, exactly.
They put a lot of cash out there.
Right. So that's what we're looking at. So now we're going to shift in that third quarter is where a lot of the tariff impacts could be seen. Mm-hmm. So that's why we're expecting that inflation is going to tick up. Their companies are going to pass some of their tariff-related costs on through to customers too. So again, we got to watch that consumer spending. That could start to tick that down a little bit. Restrictions on immigration could contribute to labor shortages. We're hearing about that a lot in the produce, farm, agriculture markets. Right. Could possibly lead to inflation in services as well. Consumer prices should begin to slow in 2026 amid weaker demand and lower business spending. So overall, go ahead.
Overall,
well, I just think
we're
overall,
okay right now.
I think we're doing well. We've got some things that we're watching, and when we say the money managers too that we work with that are managing your portfolios, they're obviously watching these things too, and they're responding very proactively. But right now, there hasn't been a lot of bad news to respond to.
Right, and that's where I was just going to go with this. Is we've painted a nice picture year to date. That's true. This paints we got to be pretty cautious coming forward. September could be a very telling month. We talk about maybe that's when we'll be seeing some shortages on the shelves, some stuff from China that didn't make it in the last few months, works its way through the supply chain, and it's not getting to the supermarket. That's going to be bad.
Yeah.
Inflation could go up. All of this is true. So come September, we got to figure out. But between now and September, there's no reason to pull back. We're in a good shape here. And our money managers, they're very tactical. They have the ability to trim the portfolios, to raise the cash if need be. But we're nowhere near that, and it's no reason to start now to go, holy cow, pull the alarm lever.
Right.
That's not now.
No.
So for now, we're in a good position. We're enjoying the market up. Yeah, we could have a little turbulence come September, October. Let's see how things play out. But let's not borrow trouble.
Yes.
Right? Let's just stay calm, stay invested, and shoot for the higher ground.
That's right.
So, Jeff, I want to thank you, man. You put a lot of time into this,
Well,
and we get this all together. I want to thank everybody for tuning in. And remember, we're always here for you. Give us a ring if you have any questions or concerns, and we hope you have a great summer.
Yes.
Take care.
Thank you. Bye.
Bye-bye.